globally, whilst also building a dynamic, resilient IFA team by providing them with guidance and support in order to dominate the financial services industry on the African continent. He's led Africa, Holborn Africa, from a team of 6 to nearly 85 over the last 4 years, whilst also simultaneously chairing the investment selection committee with responsibility for circa $3 billion of client assets across the group. Joining Lorenz from VAM is Rob Gordon, one of the industry's great voices of reason, a seasoned manager of multiple well-known brands such as Bank of America, Fidelity, Treehouse, and over a number of decades. Rob, thank you very much also for taking the time to join us all the way from Boston here today. So welcome to Lorenz, welcome to Rob. Okay, let's move on and get straight to it. So nothing too dramatic. Lorenz, what's this all about?
Thank you, Mark. Yes, it's always a great opportunity to chat to people, and I don't think we could have timed this webinar better. The convergence of various different factors around the world is causing virtually every news channel that you can think of. It's causing all sorts of problems out there at the moment for investors. Let's start with the first one in front of you. Inflation is at a 40-year high in the developed world. We have not seen inflation like this since Ronald Reagan was the president of the United States. This is a big question mark on everybody's lips, is what are we going to do with this huge inflation? But then if we look further ahead, we see that interest rates are now being put up by the central banks, by the Federal Reserve, at such alarming rates, 25 basis points, then 50 basis points, maybe 75 basis points. It's keep going up, and it's causing huge turmoil in the market, in the bond market, in the equity market, and it's causing huge trouble in virtually all market balanced portfolios that we've seen over the course of the last 6 months. But then let's add some fuel to that fire, and we have got the Russia that has invaded the Ukraine. On top of that, it causes huge fears around fuel and food security, considering the amount of food and fuel that Russia and Ukraine supplies to the rest of the world. This is now adding to the problem that most people see. And the boogeyman from 2 years ago is not gone. The Chinese have locked down pretty much 7 cities. New York, I believe, is now talking about creating new mandates again. COVID is not quite as behind us as we have been led to believe. And so is it going to make a resurgence, and are we going to see more lockdowns? Another big talking point at the moment. And then finally, now everybody talks about a recession. Inverse yield curves, and people are talking about a slowdown in economy. All of these things have converged around about the same time, and the investor is asking what other black swans are out there that could possibly hit us. Could it get worse? So I think that is what we need to start about, is before we talk about the opportunity, let's talk about the actual chaos that we're seeing, and let's start talking about the war. Now, my colleague Mark is quite a student of war and has been, he's British, they all are. And so what he's done is he's sketched out a scenario for us in what is likely and what is severe and where will we likely end up. Well, we don't know, but he sketched out from a peace treaty right through to a nuclear bomb being dropped all over the world. He sketched out some ideas for us, and then we could maybe refer to Rob as our American expert, because they're also all war experts, to maybe get his insight on what he thinks is a likely scenario. So Mark, over to you.
Thanks, Lorenz. So yeah, what we've got here, ladies and gentlemen, is a Laffer curve with most of the scenarios represented on them. Up the axes on the left, you'll see likelihood. So what we see is most likely at the top and least likely at the bottom. And then from a severity from left to right. So the first scenario in bottom left, not likely, not very severe, would be Putin calling it a day and basically withdrawing from Ukraine. I think they're too far into it now for that to be a realistic scenario. As we go up the Laffer curve, we see one of the sort of outlying scenarios, which is Putin being perhaps replaced, assassinated from the inside. Maybe the sanctions have bitten so much that the oligarchs take action. Will be interesting to see if that ever does play out. I'm just going to skip over to the scenario in the center. I think this is Putin's objective from the beginning, was a puppet regime in Ukraine. And actually that is falling in likelihood the longer that this conflict goes on. So what we have up the top are the three sort of most likely scenarios. So the first one is some kind of drawn out, long-winded conflict, maybe a military stalemate. And then the other two scenarios are maybe an east-west Ukraine, like an east-west Germany split of World War II, or some kind of deal around, Ukraine potentially joining the EU but not NATO, and maybe a blend of those scenarios is currently, what the most likely situations appears to be. The time frame isn't clear though. This could all be done and dusted in a few weeks. It could still be going on for months and years into the future. But that's not really what everyone's worried about. Where we get worried really is we come down the right-hand shoulder, so it's becoming less and less likely, but more and more severe. And the first scenario is an outright conflict between NATO and Russia. So in that scenario, we are in a global war. There's no two ways about it. That's the World War III scenario, and it'll probably come about as a result of maybe a misjudged missile or a mistake, or maybe Putin does actively put boots into the Estonian forest. We don't know. Linked on from that then is World War III plus. So China is then drawn in. Maybe they invade Taiwan. All those kind of worst case scenarios. Again, not very likely. They've actually been quite peaceful in their rhetoric thus far, but we'll wait and see. And the last one, the least likely and most severe, is outright nuclear war. I think we have to be aware that could happen, but at this moment in time, I'd like to think that common sense will prevail. So with that as our backdrop and the scenarios that are there, obviously we need to then sort of thread that into markets, and that's where I'd like to introduce Rob. Rob, this is an interesting slide that shows us what's happening with the S&P 500. What's your kind of take on things?
Yeah, sure. Thanks, Mark, and thanks, Lawrence. The shoulder scenarios to the right that you put up, where NATO gets drawn into the conflict, or where there's some form of nuclear conflict, are almost unthinkable from, say, an economic or market perspective, because that truly is a black swan, and no one really knows the implications of that other than they would be extremely severe. So it really gets back to the more likely base case that you outlined, which is that the conflict continues to drag on, and whether that's a stalemate of backwards and forwards successes by the Russians and then by the Ukrainians, and that it drags on for months and months. That's sort of the base case, and really the only one that you can sort of talk about realistic scenarios as it relates to the market on. And I guess I'd not to be tongue-in-cheek, because the human consequences of this really defy description as to what's going on. But from a market perspective, I guess the analogy I would draw, or the expression I would draw, is from the movie Jurassic Park, which probably most of you have seen, and I'm sure many of our listeners have seen. There's a very famous line in there by the actor Jeff Goldblum, who said, "Nature finds a way." And the market and the economy, more specifically starting with the economy, finds a way as well. You guys referenced the consequences as it relates to energy and the disruption of the flow of oil and natural gas, as well as grain, wheat, soybean, sunflower. Ukraine and Russia combined, I think, are 30% of wheat production. Ukraine is roughly 10%. I think Ukraine is something like 100% of sunflower production. So those numbers are quite striking. So do we have a food crisis in the making? And information that I've seen, starting with food, tells us that there is enough production of wheat-based, soy-based products around the world that we can do without Ukrainian and Russian. That was a slip of the tongue there, I guess, right? Russian production. It's a matter of dollars to move it around. And I saw a United Nations figure this morning that said it would take about $18 billion worth of aid to get various foodstuffs, basic grainstuffs, to the countries that would otherwise suffer because of disruption in Ukrainian production and Russian production. And while $18 billion sounds like an enormous sum of money, and it is, U.S. Congress approved yesterday a $40 billion aid package to Ukraine for arms and related support. So if the UN does need to get its act together, if this does drag on, then a food crisis can be averted. It's simply a matter of raising funds. There's already significant activity underway as it relates to dealing with the energy crisis in terms of shipment of gas and oil and pipelines being disrupted, where the U.S. can and is increasing output. There's ongoing discussions with OPEC. There's discussion of lifting sanctions around Iran for them to increase production and shipments. So ultimately, the markets and most importantly, the economy, as this drags on, will find a way around what's happening in Ukraine. That doesn't minimize, of course, the human tragedy that's underway, but the economy and then the markets to follow will ultimately find a way around this conflict. Again, assuming the base case. If we get back to your shoulder scenarios of a NATO conflict or a nuclear conflict, almost imponderable at this juncture in terms of what that would mean to the economy and markets.
And I think this next slide sort of sums that up. We kind of feel like it's an agonizing market. I'm sure there's a lot of clients and prospects and various people that are listening to this discussion today, and they're thinking to themselves, well, it's an agonizing market. Lawrence, can I bring you in at this point just to sort of tell me and those that are listening, what do you feel is an agonizing market? Why?
Well, the word agonizing is probably the best description, because it's very sore when the market falls, whether it's your own money, whether it's clients' money. It's not nice to see, but the agony is more perpetuated by what you see in front of you now, is the news media. And when I sat with Rob the last time when we talked about the media, and I'll bring Rob in very shortly, it always talks about the today. What do we see today in the news? And today the market looks agonizing. When you look at it over time, it doesn't look agonizing at all. In fact, we've got a slide shortly after this. Now, if we look at, for example, the S&P 500, we are now officially in bear territory. So if you look at S&P just literally 1 year ago from today, you can see that it was trading at 4,200, today 4,120. So officially, we are in a bear market. We're definitely in one in the NASDAQ and many other indices. So it looks like it's a huge agony. For the investors that came in late last year, sort of October, November, for them it's even worse, because for them, they see an enormous drop from 4,700, near 4,800, all the way to 4,100. And those news channels say that it could go further. But if we look at history, it doesn't always look like this. But certainly, Rob, if I can bring you in and we talk about the scenario that we sketched out together about what the news talks about today and doesn't account for tomorrow. You want to just sort of chime in there and discuss this with us?
Yeah, I think history is extremely important, because history is a guide, right? That's why history is such an important topic in school at all levels, because history is an important guide. If it's studied properly, it can predict the future. And if you look at the history of the markets, to your comment, Lawrence, the news media operates in a 24-hour news cycle now, and they want to grab people's attention. And the way that they grab people's attention and investors' attention is by printing headlines and throwing out data and shocking you and alarming you, because that's what keeps you listening and watching. And frankly, that's what attracts advertisers. So that's what the news media is about. Not to disparage them, they provide important information, but they're moments at a time because they have to fill that 24-hour news cycle. Hopefully, none of us are investing on a 24-hour basis. We're investing for the long term, right? We have far off objectives for our investment portfolio based on life goals. So we measure success over years and as long as decades. And if you look at history and you ask yourself, is this time different? I think if you look at the various decades, and I'm not going to go back to say that the 1930s, when none of us are around, but really look to sort of more recent history that certainly that I lived through, and I'm sure many folks listening to this call have lived through. I'll start with the 70s. And in fact, there are a lot of parallels that are being drawn between what we're going through right now and what happened over the decade of the 70s. And I'll talk about the 80s and 90s and present as well. But starting with the 70s, you think about what was going on then. We had the Arab-Israeli conflict, so war in the Middle East. The Vietnam War was still raging on, well into the middle of the 70s. You had the Nixon Watergate scandal, which brought down the US presidency. You had the oil embargo with the OPEC countries. For those of you who've been around as long as I have, I remember sitting in my parents' car as a kid, waiting in line for over, for hours at a time on whether our day was odd or even based on the number on our license plate to get gas. You had the recession in 73 and 74, so a significant market pullback then. And interest rates were approaching 20%. So we talk about where interest rates are now. Imagine 20%. Boy, that's when I really wish that I'd had the funds back then to buy a 30-year US Treasury. So with all that going on, by the end of the 70s, the market was positive, right? That based on the news flow that real events, real tragedies, as you compare them to what's happening today, not to diminish at all what's happening today, you had a lot of things going on in the 70s with a market that still finished the decade up approximately 5%. And that set the stage for the 80s, which saw a market return of almost 300%. And I recall in 1983, I was a senior in college, so getting ready to enter the job market, and unemployment was 10% in the US, right? It's at 3.5% today. We have full employment in the US. And so you saw incredible returns during the 1980s. So then that ushered in the 1990s. And you'll have to bear with me again on the history lesson, but this is important. The 1990s started with another recession, July 1990 through March of 1991. So a brief recession. But then that was followed by one of the best equity market decades in our history with returns of 417%. Okay, now let's move into the 2000s. And that's more recent history, and we're all familiar, I think, with what happened during the 2008-2009 financial crisis. Leading up to that, we had a great market. And then the financial crisis, due to over leverage in the economy, occurred, and the S&P 500 index, the broad market, fell 57% in 17 months, right? So that's a breathtaking kind of hold your breath kind of number. So when we hit the low in the first week of March that year, so let's take the first week of March that year to a recent time, the first week of May, we just concluded last week, the market is up over 500% from that time period. So throughout that period, throughout those decades that I just ran through, all kinds of tumult and chaos, very appropriate name for the session this morning. There's been no shortage of chaos over the decades, recession after recession, but yet decade after decade of return where investors didn't just see modest returns, but saw their portfolios increase by fold after fold after fold. And this is what happens. This is what happens in markets. You go through economic cycles, you go through market cycles, and if you persevere through each of these cycles, it's an opportunity to make a lot of money. And you can't time these cycles either. You can't time when these periods take place. I think you're going to show some interesting data as to when returns happen over discrete periods of time. I'll make one final point on history. Right now, there is certainly plenty of bearish sentiment, and rightfully so, based on the slides that you put up. Bearish sentiment on the market, and today we're looking at bearish sentiment of around 60%. And the last time we were at that low or that high sentiment in the marketplace was March 5th of 2009, just before we started the bull market that gave us the 500% return through the first week of May. And I'm not saying that I'm not calling a bottom now on the market, but certainly a contrarian perspective is a healthy perspective, and it's one that usually pays off in the market. So that's a sort of a quick history lesson. The question of this time, is it different? As you look back to history, I'd say probably not.
Excellent. Thanks, Rob. And as always, amazing insight there. So Lorenz, we've got a slide up here now showing different asset classes. What's this all about? What's this mean?
Well, certainly in the last decade, me personally, I've not seen this much uncorrelated risk. And what I mean by that is, normally, if you're going to be in equities and that comes down, bonds are going to hold up for you. If you're going to be in commodities, then something else holds up if that comes down. I remember, invested in a commodities fund. I think it was around about 2011 or 2012, and it seemed like it was the golden fund, and literally it ceased by about 80%. But then equities sort of held up and bonds held up. So as long as you were diverse, then you were okay. But today, not even cash seems to be a safe bet, because if cash is inflating at 8%, we're guaranteed to lose 8% a year on our cash. Our equities have fallen by 20, 30, 40, 50%. Bonds have fallen by, even treasury bonds, as I spoke to Bob, has fallen. And commodities have gone through a spike, but that was also now probably at an all-time high, and it's extremely volatile. And really, the big question is, where do you go where it feels safe? And currently, it doesn't feel safe for anybody. And Mark, you very rightly said this is probably the reason why, is because there's so many attacks. It looks like a messy dartboard, and everybody just chucked many things at it. So Rob, I probably just ask if my realization is true. Is it a huge amount of uncorrelated risk all culminating at one point, or have I got it wrong?
No, I think you've got it right. And if you think through the various periods that I just ran through, there's always lots of uncorrelated risks out there. And for those who are listening, who are still trying to think through, what does this concept of correlation and uncorrelation mean? To put it in sort of simple terms, it's when your spouse, your boss, your kids, and your neighbor are all fighting with you at the same time. And you're trying to figure out, how do I balance what everybody's throwing at me? Where are there opportunities to find peace? Which battles do I need to fight, if you will? And I think that's sort of the question you're posing, as to what do you do with all these uncorrelated risks? I think first, stepping back to the history that I just covered, the important punchline of the history is that over time, if you stick with a portfolio that your advisor has helped you engineer, that's based upon your financial goals, and you, as much as possible, ignore the noise, then things are going to be just fine in the end. You'll achieve your goals and objectives, because you're going to stick to the objectives-based portfolio that your investment advisor helped you engineer. That said, you're going to work with your advisor to tweak that portfolio as opportunities arise or as risks are created in the marketplace. And that's how I look at correlation. It's really an understanding of what are the different forces at play, what's affecting the equity market, what's affecting the bond market, what's affecting other less correlated asset classes like property or infrastructure or precious metals. And you're going to say, are there opportunities to tweak my portfolio along the way or protect my portfolio, investment portfolio along the way based upon these risks? And we can talk about, Mark and Lawrence, the different asset classes as we go along with the discussion today as to, are there opportunities in bonds? Are there opportunities in infrastructure? What do we think of the equity market based on different scenarios? And those are the tweaks that we can, if you will, play with in our portfolios. But by and large, we need to stick to our objectives and our goals-based portfolio, and then address these risks and opportunities that come along the way as we deal with these sort of uncorrelated events that present both those risks and opportunities.
Brilliant.
Thanks, Rob. And I think this sort of final slide on this section sums it up. I mean, it looks pretty terrible. I'd even go as far as saying it looks a bit cack out there. Lawrence, what would you say? I mean, what's your view, and where are we in that sort of crisis mode at the moment?
Yeah, I think if you look at what investor sentiment is like, if you like me have many clients across different continents of different walks of life, some very experienced investors, some not experienced at all, right from the experienced investor through to the unexperienced, right from the most calm investor through to the more anxious investor, they've all been highlighting this year how this is hurting, and it's a difficult thing for an advisor to stand your ground on what you've built if it's down 20% or it's down 25%. Now imagine we hit 2008 levels and it's down 55. But of course, if you look at it a decade later, it's those assets have 3x, 4x, 5x since that bottom. So whilst the story looks bleak at the moment, it never continues. And when we get to the further slides, that'll be the first one to talk about. I think the next one that's coming up is probably the biggest one to talk about, which is the bull market and the bear market. And for those who don't know why it's called a bull market and a bear market, because not many people know, but if you look at how a bull attacks, especially the matador, you will always see the horn going down to the floor and then it comes up. So it attacks up, always up. So that's why a bull market comes from the bottom and it goes on the way up. And if you look at a bear, how a bear attacks, it comes from the top and it goes down to the bottom. This is why they're called bull and bear markets. I have a set of bull and bear cufflinks that are always fighting. But the interesting thing about bull and bear markets is that bull markets will always outlast bear markets. The average length of a bear market is 15 months. The average length of a bull market over time is 7 years. So you just need to be in that market for time. And the slide that you see in front of you, look at all the geopolitical events that you've seen. Look at the Cuban Missile Crisis, look at the Vietnam War, look at the oil shock, look at the Iran-Iraq War, look at the fall of Berlin Wall, look at the Gulf War, look at the Iraq War. The only big red one that we see here, the big red one, 6 months later is when Russia invaded Georgia. Let's be honest, that was 2008. It's got nothing to do with Russia invading Georgia. It's got everything to do with the global financial crisis of credit default, and it's got nothing to do with war. But the key thing is, if you look at that 6 month later mark on the right-hand side, you will see that the bulls 9 out of 10 times always win. It's always a bull market later. In fact, had this bull been a more bear market than bull market, we would not have a stock market because no one would invest any money. And so, yes, it's a tough thing out there, but you just have to wait it out. And you can see that history from the 60s, even from the 40s, since Pearl Harbor, this thing is unchanged. It's always a positive market here. This is just 6 months. When you look at it a year later, they're all blue, with the exception again of 2008. You have to wait 2 years there. But yeah, I think it's it's crap at the moment, but it is just to hang in there, and we'll survive. Rob, your thoughts on my gibberish?
Yeah, no, it's not gibberish. It's spot on, and I think it really gets to why is it so important that the U.S. Fed does its job right now? Because there's a lot of folks who would say, why does the Fed need to get involved at this juncture? They've let things go on as they have. I can, when we talk about economic strength of the U.S., I'll quote a bunch of statistics. The U.S. is in an incredible position of strength economically at the moment. So you'd say, well, do we really need to tackle inflation? Does the Fed really need to start raising rates? Because if the economy is strong and we've got all these negative events going on in the world right now, why don't we just let the market and the economy continue to do its thing? And I think what's important about the numbers that you put up is that throughout each of those periods, we had economies that found themselves, after going through brief recessions, on solid paths. And that's not an accident. There's a lot of central government intervention, not just the US Fed, but central governments globally that get involved with, yes, admittedly blunt instruments, using interest rates to keep economies on a solid path. Because if you let inflation run, and certain countries do that. I mean, you look what's happened to South America over the decades, and you hear about inflation rates in the hundreds of percent. So you look at what's happening in Turkey right now as they try and keep interest rates low, and the massive inflation that they're experiencing and how that's ruinous to the economy. That's the goal of the U.S. Fed right now. Recessions, as you've noted, are typically brief. And yes, they can be painful, especially if you're on the wrong end of losing a job, and other financial consequences to your portfolio. But they are generally brief, and the expansions are long. And so that's the game that the Fed has to play right now, or the endeavor that's in front of us, is killing the corrosive cancer that inflation can be, that can ruin economies over extended periods of time. And if that invokes a recession because of the extent to which they need to raise interest rates, so be it. That will be painful, but it will also be the pause that refreshes, that gets us back to, as you pointed out in your data, long-term sustainable economic growth that rewards not just the economy, but the markets as well. So the goal right now is for the Fed to dampen inflation, which means dampening demand. It may push us into a recession, but that would be the pause that refreshes to get us back to the kind of expansions that you just put forth in your data.
So an interesting slide that Mark is about to share is just something that came off of a train journey with him, and I'll not say too much, but with Rob saying that we're kind of where we are in terms of sentiment where we were in 2009, I think this slide is even more powerful. Mark, you just want to tell us about this?
Yeah, I think this is a great indicator. This is a sentiment point here, and I'd be interested to get Rob's view on it. So CNBC are one of the big TV cable companies in the US, and they have a markets in turmoil special. And I'm not saying that this is a bottom indicator, far from it. I'm interested to hear Rob's view on it, but they also have a presenter called Jim Cramer who comes in for a lot of stick around, what you should and shouldn't be buying. But interestingly, when you look at when they do their markets in turmoil specials, okay, and they've just done one on the 5th of May. That's why I'm raising this as a point. A year later, every single situation they've done this over since the 2010, so there's 12 years worth of data. Markets have been positive from where they are when they do that special. So they're screaming that the sky is falling. It's going to keep going worse, what have you. But a year later, the clouds have parted and the sunshine's come out. The birds are singing, as it were. And actually, when you look at the average return a year later, it's 40% higher. So, Rob, what's your view on that? Are CNBC right to be playing to people's fears from a sentiment perspective? What's your thoughts?
Yes, no, the data is right. I guess the question would be, what's the starting point for the year, right? When does that year start? And that depends upon really which outcome you see as it relates to what happens with the economy. How does the Fed do its job? Because it's interesting, as much as sentiment is at the 60% number, and as much as the broad market, the S&P 500 is down now roughly 16, 17%. Things could get a little worse today. As we saw inflation numbers come out this morning are still running hot. We had hoped for to see it peaking, but it's still running hot. But yet within all that, there hasn't been what to use some industry jargon, what we haven't seen is capitulation yet in the market, meaning investors are concerned, right? That's what that 60% number indicates. Sentiment is poor, but they haven't given up the ghost. They haven't capitulated. They haven't started this mass selling that often happens at precisely the wrong time in a market turn. So we haven't seen that capitulation yet. And I think some of that is because investors are waiting to see which scenario do we end up with. Is it the soft landing scenario where the Fed has to do its thing with raising interest rates, but the U.S. and global economy is strong enough so that it can weather that rise in rates, and in which case we have what's called a soft landing as opposed to a recession. If that's the case, then one would say maybe we are near market lows, right? Maybe the sell-off that we've had so far in the market is enough, and then that year starting point could start, pretty soon, if not now. The other scenario is that the Fed has to do a lot more than engineer a soft landing and take us into, say, a mild recession, in which case the market has further to fall. Anyone's guess as to how far that is, but that the market could see continued downside, and so that year starting point that you're referring to could be further off. But regardless of whether we're there now or we're there in 3 months or 6 months or 12 months, the data bears out that these cycles do hold and they do remain intact, and that the opportunity will be there when we start to find that bottom. The thing is, and I think Lauren's implied this as well, we don't know where that is. And the idea of trying to time that is a fool's game. And I'm sure you guys will talk more about that.
Well, you can see on the slide in front of you about trying to time things just post the Great Depression. And you can see what the S&P 500 looks like when you try and time it versus just leaving it alone. So if you look at the decade of the 1940s to the 50s, if you managed to time it and took out the worst 10 days, you made 136%. But if you pulled out the best 10 days, you made negative 14. And I've never met the person who can time the 10 worst days and the 10 best days in a year. I've never met that person, because that person, Warren Buffett included, does not exist. But if you just left it alone for that decade, you made 51%. And the following 10 years, you made 293%, and 54, and 8, and 328, and 330. And then the one, what I call one unfortunate decade, is that you had a financial crash right at the start of the decade and sort of towards the end of the decade. And I think that is what, and they were two big ones, by the way, the dot-com bubble crash and the financial crash. They were big market correctors. So I think that was a bit of an anomaly in the general scope. And then if you look at what 2010 brought after that, even if you just stayed in from 2001 to 2011, it would have been positive. So it was just literally from 2000 to 2010. And then, of course, from 2020, if you were an investor and you had been in, you were up 27% on the S&P 500. It's only unfortunate for the people who really right now have been an investor from circa 2021, really. They're the only ones who felt any pain. Everybody else is still in positive territory. And I don't think that that story is going to remain unchanged. Rob, your views on this?
Yeah, I think it makes the point that while we talk in terms of decades, as we look at history and, the phenomenal returns that we've seen in the decades, just go back to some of the numbers that I threw up, 300% return during the decade of the 80s, over 400% during the 90s, over 500% post-financial crisis. When it comes down to, well, when did these returns occur over those 10-year periods? We all wish it was an even return each month, so we could say, now I'm ready to get in, but you can't do that. The returns happen over very brief, discrete periods, which cannot be timed. So it's amazingly easy during these extended periods of time to miss the fantastic returns that can result by being in the market. You've got to show up. Basically, you have to be there in order to get the returns. No one's going to call you. There is no financial advisor on the planet, including, as Lauren said, look, Warren Buffett, who's going to call you up and say, now is the time, now is the day, now is the week, now is the month. It doesn't work that way. You have to be in the market. And certainly there are opportunities to take along the way, as we talked about things like uncorrelated markets and asset classes and things. But you really have to be fully invested at all times. And that gets to the importance of things like, and I'm sure your financial advisor tells you, which is you need a cash cushion as well for periods where, during a recession, if you find yourself unemployed, other cash needs to take advantage of various opportunities. But you always need that cash cushion, because to dip into your long-term portfolio, to start using equities as a form of liquidity, you're going to miss out on the kind of results that Lauren and Mark put up on the slide here. You can't predict it. You can't time it. Anybody who tells you they can, well, they're going to sell you a bridge as well.
And I think if we look at the slide in front of us, if you look at just the S&P 500, since we started tracking it, back in the day, obviously it's run much longer than this, but you can see these volatile moments and you can see what the result is. So just the one prior to the current one was COVID-19, and you can see how short-lived that was. That was a 35% market correction as it goes. Then the one before that was when the Fed unnecessarily, I would imagine, or surprisingly for some, just went and put up interest rates dramatically in 2018. Then if you look at 2015, this is when the China crisis came about, and you've got the global financial crisis, you've got dot-com bubble, and many things in between. But you can see the comment that Rob made was the market always finds a way. Nature finds a way. And this is the result of where we are as humanity and the continuation of progress. So yeah, I think this is quite a great slide, because if you look at the slide that just shows a year, it looks like for the last year we're down. If you look at 6 months, it looks like it's down severely. But anybody who needed cash only should never have been exposed to a market over the course of the last 6 months. But people who are looking to long-term invest, they have to be in this market. They cannot be out, and they cannot time the top and the bottom. But you can see over a stretch of time, the bulls will always outlast the bears. So I want to bring Rob in again on this slide, because it talks about institutional mentality versus retail mentality. This is a very, very very perfect slide in my opinion. And the reason why this is a perfect slide is what happens on Black Friday. Okay, On Black Friday, it is the best time in the US. Now, personally, I was in New York City in 2009, I think, or 2010. On Black Friday, I was in that very store, Macy's, on a Black Friday sale the day after Thanksgiving. And I went in there like a kid in a candy store, and I bought so much crap that I needed to buy an extra suitcase to take with me back to London, and I was still charged overweight on the extra suitcase on the way back. That's how much bargain basement goodies I picked up on that day. But when the stock market goes into a Black Friday or a Black Monday, everybody, excuse the term, but everybody shits their pants. And the question is, why on earth are investors not seeing it as the Macy's Black Friday? Rob, you want to talk a little bit about this investor sentiment versus shopper sentiment?
Yeah, but first, a comment on your shopping spree in New York. It's funny. I have a friend who works a senior position at Marriott, and he's responsible for the Marriott hotels in New York, and he experiences folks like you all the time, where a chronic problem for them are folks leaving behind suitcases of clothes and things that they brought with them on their trip, that they leave behind because they're buying the bargains that they find in, that are relatively cheap in New York based on whether it's currency values or whatnot. So they have basements with storage that are full of suitcases from foreign visitors who really left behind everything they brought with them to fill new suitcases with things that they purchased. But yeah, it's a good comparison, a good analogy to the market, because remember, there's a reason it's called a market, because it's full of buyers and sellers. So during times of fear, there's always someone on the other side of that, and his name is greed, right? Or it could be a her as well. I don't want to discriminate. So when that retail investor is full of fear during downturns like this, and they decide, I've got to go to cash, I'm going to take a loss, I'm going to risk permanent impairment of my capital, meaning I'm going to lock in that loss because I think things are going to get worse, that the bottom's going to fall out. And they sell those stocks. In order to sell those stocks, there has to be someone on the other side of the trade. There has to be someone to buy it. And that someone on the other side of the trade is often an institutional investor, someone who sees, great, there's panic, there's blood in the streets, there's fear. And it was Warren Buffett who said, when those who are fearful, it's time for others to be greedy, something, paraphrasing. And that's what many institutional investors see during times like this, is they're going to be retail investors and some institutional investors who panic as well, and who sell when markets are low, when markets are cheap, and they're buyers because they're getting a bargain. And that's how the markets work. It moves from people look for opportunities to enter at periods of cheapness, and in order to do that, there have to be those who panic, who sell at the wrong time, who sell in downturns or near bottoms.
Thank you, Rob. I'm just going to move on. And before we do, ladies and gentlemen, we're going to be opening up polls shortly just to get your view, gauge the sentiment in the room, as it were, as to what we think is happening out there and how you're feeling. So I'll launch those shortly. Lawrence, what's this slide about, the fundamentals?
Well, a comment that came in on the Q&A, and by the way, please do send in the Q&As to Mark along the way. But a comment that came in on Q&A, and I was waiting for that one, was, do we think that the markets will fall as much as 50% or plus like they did in 2008? And the reason why this fundamental slide comes up is what I wanted to quiz Rob on, is what are the fundamentals of the underlying holdings that you would have typically in a portfolio today? How does that differ to what the fundamentals were just pre-financial crisis 2008 or 2000 for that matter? Because I think fundamentally, this is just a personal thought, I think fundamentally things were broken in 2008, and I don't think they're broken now. I think the fundamentals are absolutely excellent. But Rob, your thoughts?
Yeah, that's a really important point, Lawrence, because that gets into how the Fed will act as it relates to raising interest rates as well. Because to your point, it wasn't just the markets that were declining during the financial crisis, but in fact, it was a true financial crisis, and there were concerns about the viability of the financial system. And that's why you saw major banks, Bear Stearns, Merrill Lynch being or Lehman Brothers going out of business or being bought by other financial institutions. You had a near collapse of the financial system, not just the markets. You don't have that today. In fact, you have financial institutions like banks and brokerage firms that are in very strong positions with very strong balance sheets. You have companies that have very strong balance sheets, plenty of cash and liquidity on hand, and the consumer is in excellent shape, not over leveraged the way they were pre and during the financial crisis. So it's a very different climate right now, which is why when I'm asked the question about, well, will the Fed keep its foot to the gas on raising rates, even as the market falls? Is the Fed that heartless that they're not going to worry about the market? And in fact, what the Fed doesn't worry about the market. The US Fed does not worry about the market. And if the market is down 10 or 20 or 30 or 40%, what they worry about is the financial system stable? And right now, the Fed looks at not just the US financial system, because it has a global responsibility in some respects, but looks at the global financial system and says, not only is it intact, but it's strong. So if that means that we take it on the chin during as we raise rates and conquer inflation, and that creates a downturn in the equity market or even a mild recession, that's worth the price of conquering inflation and giving us a strong economy and the pause that refreshes, that'll send us back onto another period of economic strength and rising markets.
Cheers, Rob. And Lawrence, I think this is quite an interesting slide. We were, again, talking about that train journey. We were chatting about the ladies and the lipstick. I think that's a lovely story. Tell us more about that.
Well, yeah, like people always ask, if markets come down, are there opportunities? Obviously, that was the title of the webinar today. So if you look at the company on the top left there, Estée Lauder, which is one of the largest makeup producers on earth, just a couple of facts. Firstly, during the First World War and Second World War, the only industry that took no knock, the only retail industry that took no knock was the makeup industry. Women would walk out of the house in the Second World War still with the same amount of red lipstick on as they did always before. But if you look at this company and if you look at its adjacent companies and the ones underneath them, the opportunity inside businesses like this, now they've all sold off. They're all down 20, 30%. They're all down 20, 30% on things like interest rate fears. And these companies all fund their businesses through cash. They are not depending on borrowing from a bank. They are not credit dependent at all. They all fund their businesses through cash. Microsoft, Nike, Amazon, and many, many others that we invest in. So should interest rates worry them? No, if anything, it means their cash returns more money. And a bigger thing is, well, should they worry about inflation? Well, all of these companies have got an enormous amount of gross margin, so they could swallow some of the inflation. But key thing is they don't need to, because they can pass their cost on to the consumer. If you look at Microsoft, for example, Microsoft can say, look, our services are just 7% more expensive this year. If you don't like it, you can shelve it, but it's too integrated inside of the of the company's underlying technology that they cannot just shelve it. If someone is taking Amazon Web Services, they are taking Amazon Web Services. If someone is loyal to a brand like Estée Lauder or Nike, they're not going to switch. Like heaven offend, a woman switches her to a cheaper makeup brand because times are tough. That is just not going to happen. So these are the types of businesses that we see as excellent opportunities. Now, not just these ones. I mean, there are many like them. But all of this fear mongering that we see on the news channels around interest rates and inflation and recession, you know, some companies are robust against all three. And the question is just, what are we doing to educate our clients to make sure that they are investing in these types of things? And this is Rob's slide that's coming up here. And the reason why this slide is pertinent is because the sell-off that we've seen is predominantly going from what we would call the previous good stocks into what I think is absolutely awful cyclical stocks. And it's provided a source of funds to these stocks. And Rob, can you just sort of talk us through this old economy, new economy story, and why we can't look back towards the future, you know, with our backs towards the future in terms of what we invest in, and what really is going to change the world in the next 10 years?
Yeah, that's so important, Lawrence, because the companies, certainly the cyclical companies, and when we use that term, we talk about companies that respond to business cycles, supply and demand. We're seeing right now that's the particular energy and materials, you know, the oil companies and some of the financial institutions, and they're doing well now for a couple of reasons. One is because there's a shortage of these resources, and that's why we're seeing energy prices go up. There are supply issues and there's very strong demand. That will all change very quickly if the economy truly does start to slow. And goodness, if we go into a recession, you're going to see oil prices plunge. You're going to see interest rates start to come back down and banks lose the spread income that they've been appreciating off of recently. So these cyclical stocks, as the name denotes, will go through these cycles that are solely based on this sort of supply demand and interest rate dynamic. Whereas as Lawrence termed them, the new economy companies are much more perennial in terms of their strength, their ability to grow, their ability to provide products and services that consumers want, because they're forward-looking companies that are solving the world's problems. So whether it's through technology, whether it's healthcare, biotech, you're hearing more and more about green energy solutions and infrastructure. The kind of companies that we saw do so well during the COVID recovery, e-commerce companies, the whole phenomenon of work from home, shop from home, entertain from home. These are all companies that are doing things for the economy and the consumer and institutions and world problems and solving world problems that are the real sustainable growth stories. And with the sustainable growth story, you're generating sustainable and growing earnings, and sustainable and growing earnings are the engine of the stock market. So those are the kinds of companies and industries that have real legs to them. And that's what you want, frankly, in the majority of your portfolio. And increasingly, as you look at the market indices, they're predominantly populated with these types of companies. Certainly, their prices have come off, and they've come off severely recently because these prices were elevated really as a result of, I think, the COVID recovery. It's not that these companies have suddenly seen market declines as a result of poor fundamentals. The fundamentals or the underpinnings of these companies are still exceptional. So this is really more of the pause that refreshes. The cyclicals that we're all chasing right now, energy, materials, and financials and others, are really, in our opinion, sort of more short-term events or short-term phenomena as a result of what we're experiencing right now with inflation and rise in interest rates. But as you think about your portfolio, and as you look at the underlying funds that many of you own, and what kind of companies portfolio managers have populated these portfolios with, they're the new economy companies that are in the technology space and the consumer space, and much less so in these cyclical names that are more temporary phenomena in the market.
Thanks for that, Rob. So, Lawrence, moving on then, let's talk about bonds. What have bonds been doing?
Well, I think for the first time in some time, there is an enormous amount of opportunity in the bond market. And I'm not talking specifically about corporate bonds. I'm more referring to treasuries, gilts, etc. And when myself and Rob talked the last time, I think he shared the sentiment. Maybe if you wanted to dig a little bit deeper, Rob, in terms of why is the bond market becoming almost equally as exciting now as what the equity market is?
Yeah, bonds are an interesting asset class because for a long time we've all wanted to hold bonds in our portfolio, but because bonds are supposed to be uncorrelated with equities. The challenge with bonds is that over this incredible economic expansion that we've had, one of the longest economic expansions that we've had in history, that was driven in large part by easy money. And that meant interest rates were very low. And so if you're a bondholder, you weren't earning much, cash, you were earning zero. In some cases, money market funds were delivering negative yields. And you were seeing even longer dated government bonds functionally at zero. And certainly after inflation, you were losing money. So bonds weren't much of an investment. So now what we've seen as inflation has risen to lofty levels and central banks are trying to fight inflation, they're raising rates. Now, the tough part of that in the meantime is that if you held bonds, interest yield and the principal value or the price of your bond work in what we call an inverse correlation, meaning when prices go up, bond prices go up, yields come down, and vice versa. So now we're in this period of rising interest rates, rising bond yields, and that means that bond prices have been falling. But the opportunity is purchasing new bonds, and as Lawrence indicated, government bonds, you're starting to get decent yields again at cheap prices. So the opportunity is starting to emerge to take another look at the credit portion of your portfolio or the bond portion of your portfolio. And the reason that we make a distinction right now between government bonds and corporate bonds, as Lawrence just mentioned, gets back to sort of safety and credit quality, that obviously with government-backed bonds, you're getting a higher credit. Corporate bonds, there'll be an opportunity in the corporate bond space as well. But I think first there we need to figure out what does happen to the economy. Do we test a mild or even a severe recession? If so, that could impact what we call credit spreads, meaning what happens to the spread between investment grade bonds and government bonds and even lesser grade corporate bonds. Are corporate bonds risky for the time being? At some point in the future, there will be an opportunity to buy corporate bonds with attractive yields. But for the time being, if you're thinking about the bond market, you can get a real yield now, and you can get it with a government bond that's going to give you the credit quality that you need from a safety standpoint. So good time to start to test that water. Maybe from a portfolio management perspective, you're seeing some folks are saying, I'm going to sell the bonds that I own today that I've had for a while that have very low yields. Maybe I'll take a loss on them, use that as a tax loss, and reinvest that into new government bonds that have been issued at a higher yield.
Great stuff. And Lawrence, probably worthwhile just touching on some of the other asset classes that we get asked about. There's some questions that we've already had, like, and we'll start to bring the questions in shortly, ladies and gentlemen. So yeah, things like small caps and other alternatives. What's your view there?
So I'll bring Robin on the small caps just shortly, because I know it's an area of his expertise and also passion. But the reason for the two boxes at the bottom is when you construct portfolios, you cannot just be in bonds and equities. That doesn't mean that you're in the wrong asset classes, but you can't just be there, because there are opportunities elsewhere. So the reason for the Goldman one there is it's one of the providers of things called structured products or promissory notes, and you have many of them. You've got UBS, you've got Morgan Stanley, you've got Investec, etc. Now these are also interesting vehicles to pick up, as there's so much volatility. And as there is an enormous amount of volatility in the market, what you see is you've got something called the volatility index, and that volatility index spikes. And when it goes like this, it means that the coupons that you can pick up on these types of structured products are typically enhanced, and so you can pick up very attractive yields on these types of instruments. So that creates another opportunity. Outside of that, you have to be inside of the property market as well, real estate market, whether it's holding physical assets, whether it's REITs, etc. These are other assets that are creating huge amounts of interest, typically because of the rising cost of inflation. So a property that I've bought, I signed the lease, well, not lease, the purchase order, I signed for it the back end of December. The property prices now, and we're talking 5 months later, is already enhanced by 10% just because of that inflationary rise. So there's a 10% increase in my property, and I have not yet owned it for a full year. But the biggest story in terms of opportunity, I think, in terms of stock market, is where small cap stocks trade as a premium or as a discount towards the greater S&P 500. And Rob, do you want to chime in there and tell us your thoughts?
Yeah. First, I'd like to comment on the alternative assets, the other assets that you just commented on. That's a very important part of portfolio of one's portfolio. The old sort of balance just between stocks and bonds, I think, is a dated form of allocating one's money in their portfolio. You have to have that other bucket, if you will, which includes assets like Lauren's mentioned, structured notes and real estate, maybe some precious metals, infrastructure, but to have that other bucket, because it's a good foil, if you will, against traditional bonds and equities. So that's always an important portion of one's portfolio. But as we look at the equity market, as Lauren mentioned, there are opportunities not just in by industry, but by market cap as well. And I am a fan of small cap stocks, small company stocks, generally with market caps of under $5 billion in the marketplace. So these are sort of the smaller companies, small to mid-sized companies, relative to the mega caps that Lawrence had shown on a previous slide. When you look at some of those companies that are in the S&P 500, we like to look at the other end of the size spectrum, and small caps have really taken it on the chin. And the reason for that, relative to the broader market, say the S&P, the broader market's down about 16-17%, and small cap stocks are down roughly double that. And one of the reasons for that is because the small cap indices are largely populated with growth stocks. And the growth stocks are some of the stocks that we've talked about that have declined the most in this economic cycle. Those are the technology stocks, the new economy stocks. So technology, biotech, healthcare, certain stocks in the consumer space, the real growth stories. And their fundamentals are still very much intact. These are still great companies, well-run businesses generating strong earnings. But because they were pricier coming into this latest downturn, they were hit the hardest from a price standpoint. So now you essentially find them on sale relative to large cap stocks. Small cap stocks almost always in market history have traded at a premium on an earnings basis to large cap stocks, roughly a 3% premium. Now they're trading at anywhere from a 20 to 30% discount to large cap stocks. So if you look at your portfolio now and you say, gee, I don't have any exposure to small cap stocks, these new economy type companies, or I had an exposure to small cap stocks, but now that allocation is down significantly just because of depreciation. This may be an interesting time to start legging in, do what we do call dollar cost averaging into small cap stocks, because we're not pounding the table saying this is it, this is the bottom, but they are cheap relative to other asset classes, certainly cheap relative to their larger cap stock brethren. So an interesting time, both in terms of price as well as the kinds of companies that are inside small cap stock funds to be taking a look at that asset class.
I think finally, this one is specifically talking about infrastructure, green, renewables, etc. And one of the fascinating things that the guys from VAM have picked up on, and I invested quite heavily, is how do you invest in future technology, in future green energy, etc. But it's the equivalent of buying things like government guarantee. So lastly, Rob, I'll go back to you on this one, but tell us a little bit about the infrastructure fund that we typically invest in. Why do we go in there, and what are the sort of guarantees that a person has in there, and how is this long-term uncorrelated perhaps to the greater stock market?
Yeah, I think, Lawrence, to start with more broadly, you mentioned sort of just the importance of infrastructure, and green infrastructure in particular. There's tremendous demand for that. I mean, it's in the news headlines every day about climate change and climate mitigation and quality of life and what are companies doing to invest in that space and the new technologies that are emerging. And then, more directly, as we go back to the conflict with Ukraine and Russia, and we're seeing that energy is being used as a weapon globally, right? We're seeing what's happening with supply chains being cut off, and are they going to deliver the gas? Are they going to deliver the oil, and at what price? And countries are realizing that they can't be held hostage to energy, because obviously it's such an important part of our economy. So you're seeing more local, and you're going to see dramatic increases in local development at a country level in energy resources. And in many cases, that has to be green energy, because not everyone has the oil and gas and coal reserves in their country. So that means greater investment in local green energy. So whether it's wind power or solar power or hydroelectric, and you're going to see a resurgence in nuclear as well. And all of that, all those in the green energy category will happen on a local level to prevent countries from being held hostage by traditional fossil fuels that are concentrated in certain parts of the world and have to be shipped, and there has to be geopolitical peace in order for that to happen. So you're going to see greater investment on a country level in green energy. And it's private enterprise, private industry that creates these green energy solutions. And this is where funds that invest in these types of opportunities stand to do extremely well over the coming months and years as green energy takes on. And then, of course, while it's private enterprises that are creating these resources through their investment, it's governments that are often the investor in making sure that these projects in green energy and other infrastructure happen. And that's what Lawrence was referring to, where there's this sort of underlying government contract, this long-term government contract where local governments are investing in these projects, in these green energy projects. And that gives the investor some kind of certainty. While there's certainly equity investments, and we'll move up and down with the equity markets, the underlying contracts to make these projects, these investments in green energy happen, fall under a long-term government contract that can't be broken. So there is a component of not guarantee, but certainty of to these opportunities that end up in these fund portfolios. And Lawrence mentioned that VAM in particular has a fund that invests in these types of projects. So it's another asset class that you should consider for your portfolio. It's another uncorrelated asset class. It's a new economy type of investment, and one that we believe has an important future ahead of it.
Excellent. Thank you very much, Rob. Thank you, Lawrence. Ladies and gentlemen, thank you for staying with us through the discussion so far. I hope you found it interesting. Certainly the poll question seemed to see that. So we're going to give it another minute before we shut the poll and release the results. And we'll talk through that as part of this sector, which is the Q&A aspect. So if you haven't already done so, please ask a question below. You find it in the center of the menu bar there at the bottom, Q&A button. And we'll try and get through as many questions there, but also we've had some questions coming in via WhatsApp as well. So let me just start off with this first question. So from one of the attendees today, Lawrence, maybe one for you. What are the chances of a full 50% pullback in US markets? We need to dust off the crystal ball for that question.
Yeah, I mean, I personally, I can't see it because, I don't see the fundamental reason why it would sell off. I don't see a broken system. I honestly think it's sentimental. Consumer confidence is still good and high. Companies' earnings are excellent. So I don't see the market in a terrible place. So personally, I think this is. There's a comment: the punishment doesn't fit the crime. This punishment the market's taken doesn't look like it fits the apparent crime that it's committed. I think in 2008 it was justified, but it doesn't look like. I think this is just a healthy reorganization of an index. I think it is just a healthy clear out, and maybe it did go with the enormous amount of money that was printed. A fortnight ago, or 2 years ago during COVID. If you look at the enormous amount of injection of capital, everything went up like this. Central banks took all the rates down. I think it's just kind of corrected. If you look at the trajectory line, it just looks like it's kind of met that line. So my personal view is that I don't think it falls to 50. Can it fall more? Sure. Is the S&P going to bottom out at 3,500? I don't know. 3,800? I don't know. But to be honest, I don't care. I just care about the underlying constituents that the person invests in and what their long-term trajectory is like. And I know that markets outlast good markets outlast bad markets, and that's the honest view. Rob, I don't know if you have any different opinion.
Yeah, I think the most important thing is what you've concluded with, Lawrence, which is good markets outlast bad markets, and it's pure speculation as to where we'll end up. Where's the bottom over time, as we've shown with all the history and charts and data. It really doesn't matter. If you want to speculate on it, it's really going to come down to how hard does the Fed have to push to kill inflation? The Fed's got the double dynamic of dealing with not just slowing down demand, but dealing with the supply issue as well. And that's what the inflationary problem is. So, right now, Fed funds are somewhere around, between 75 and 100 basis points, 0.75 and 1%. The expectation is that they need to be somewhere around 2.5, 3 to quell inflation. If that's sort of the limit of what they need to do, maybe a little higher, then you're nowhere near the kind of market decline of you're down 50%. If for some reason inflation can't be killed by that more modest rise in Fed funds, and they need to be 4 or 5+% or more in the short-term interest rate, we call the Fed funds rate, then you're going to have increased downward pressure on the market. But we don't see that. we think that, the numbers that we saw today is that while inflation is still high, it's peaking. And the Fed is very late in the cycle doing this. So I think by the time the Fed would get around to interest rates that could really kill an economy and really kill the markets, they're a little late in the game for that. I think the economy will start to reach sort of more sustainable levels under its own weight, as opposed to needing the Fed to kill it.
Excellent. Thank you very much for that response there. Rob, I'm just going to bring in the polls now and share those with everyone. So we had nearly 100 responses, which is fantastic. In hindsight, maybe we should have asked some of these questions at the beginning and see if it shifted along the way. But I'll just run through them now and maybe we can discuss them as well. So do you think a year from now, investment values will be higher, the same, or lower? Well, the majority think higher. So hopefully that's a positive sign. How have you reacted to the recent drawdown in your investment portfolio? I always say this to clients, there's always a handful of options that you can do. You can sell and turn everything into cash. You can sell a bit, you can hold on and do nothing. And 63% of people are saying, actually, we're going to stay calm, we're going to hold on and see what's happening. 31% of the people on the call are actually seeing this as a buying opportunity. And potentially, if everything that we're saying comes to pass, then potentially this could be a once in a 5 to 10 year opportunity, once, but that'll only become clear in hindsight, right? What is your greatest concern currently? Over 58% said the slow recovery of the market, and then 21% are equal between a concern about the ZAR rand and a fear to deploy further funds. And then the last one, is just showing where people are currently invested. The majority between offshore developed markets at 70% and about 28% locally within the JSE. Some interesting stats there. I'm just going to bring in a question on WhatsApp here. So this one may be for you, Lawrence, and for Rob actually as well. The US vote takes place in November this year. What are you expecting to see as a result? How are US markets likely to react?
So firstly, I've got no comment on US politics. And this is, while I love talking to Rob, we kind of sit on different sides of often sit on different sides of the political spectrum. But Rob knows the American political landscape much better than I do. So I'll cede this question. Yeah,
so I'll show my colors here a little bit in terms of, I think, unfortunately, we're going to have a Republican win right now. We have a Democratic Senate and a Democratic Congress in the U.S. And I think, Joe Biden is getting tarred with everything that's going wrong right now. Brush, in particular, an inflationary environment that he frankly inherited, some of which he's trying to address right now through things like removing sanctions from China on imports to the U.S., which have been part of the challenge in increasing prices on certain goods and services. But that aside, with that blame comes voter sentiment. We've talked some about investor sentiment. Now we'll talk about voter sentiment. Voter sentiment is you blame the guys that are in power for everything that's wrong. And that's probably going to lead us to at least a takeover by Republican Party in the House of Representatives and possibly the Senate as well. Okay, so how does that translate to the market? Well, we know the policy positions of Republicans. They're very pro-free market economy, very anti-tax. So the odds of any tax legislation coming through Congress are zero. Many of the regulations that were put in place by the Trump or removed by the Trump administration and have now been reinstated by the Biden administration. If there is a Republican Congress, they'll do their best to eliminate many of those restrictions, which are burdensome for businesses and cost businesses money and hurt earnings. So reduced regulation, no tax proposals in sight are a positive for business and therefore should be a positive signal for the economy and the markets. So As someone who's a fiscal conservative but a social liberal, I think it's ultimately a negative thing for the country and many of our friends around the world. But I think we're going to be seeing a more Republican controlled Congress, which is a positive for the economy and the markets, certainly in the near term.
Great, thank you, Rob. And we'll take two last questions to try and stay within the hour and a half. So I'm going to go with a question here. Connor, actually, could there be a case for a US recession being a positive thing in the lead to deflation and potentially bring inflation rates closer to interest rates without the Fed's input? I mean, I know we touched on inflation, where that is so far, but is recession necessarily all bad?
So we've seen the statistics that we prefer a slowdown, obviously, because sure, we need the pause that refreshes, and that means that inflation has to come down, because inflation is the real cancer. If we need a recession to kill inflation, then it can be the distasteful medicine that we take. I tend to side with Lawrence as as we look at U.S. statistics. I mean, you've got unemployment in the U.S. of 3.5%. You've got 5 million more jobs than there are eligible job applicants. The U.S. economy continues to be in a recovery stage from COVID, not in a pullback stage. So it's going to take a lot for the Fed to induce a recession. That said, if they do induce a mild recession, if that's the medicine that we need to create that pause that refreshes so we can move to another leg of expansion and growth in the economy and the resulting equity markets, then so be it. But I think the jury's out still on if a recession is in a Fed-induced recession is going to be necessary. It's certainly not in 2022. Recessions, the lag that it takes for a recession to come into bear after unemployment starts to rise is usually around 13 months. So I think if a recession is in the cards, a mild recession, we're still a ways away from that.
Excellent, thank you, Rob. Okay, I'm going to try and link two questions together because they are sort of closely linked, and that's in relation to commodities and OPEC's role. So obviously we've seen oil from a historic low in the depths of the pandemic, rising significantly, peaking, and it appears pulling back a little bit. So two questions here. So, is this the start of a commodities boom? And then linked with that, we've mentioned sort of one of the solutions potentially to inflation that's in the ether, which is suddenly Iran or maybe even Venezuela coming in from the cold and being allowed to sort of quoting ex-American presidents, drill baby drill. So Rob, what's your view on commodities and potentially oil coming from other newer sources and how OPEC might respond? What's your view?
Yeah, I'm certainly not the expert in this matter, but my opinion is that OPEC has been playing an interesting game because they've kept a tight rein on high prices. There's an opportunity then for them to play sort of a more friendly political ball, if you will, and they haven't gone that route. They've kept a tight rein on high prices. Where that could come back to haunt them, as well as the other oil producers, is if the economy truly does start to slow, and then demand slows, and we'll see energy prices come back down. So. As we talked about earlier in the discussion, energy and commodities are cyclicals. Right now, there's a shortage. There's a shortage brought on by war. There's a shortage because of the supply chain issues that we have. But ultimately, as that's worked through, you're going to see energy and commodity prices come down. There are certain commodities like rare earth minerals that are interesting investment plays because of what's happening in areas like the electric car market, and those rare earth minerals are desperately needed and in short supply for evolving technologies. But basic commodities like fossil fuels are seeing their day in the sun right now, no pun intended. but they will suffer as the economy resets.
Okay. Lawrence, any final thoughts there before we wrap up?
Well, just one, and I just wanted to throw this at Rob. At what point can interest rates go up before America defaults on its debt?
At what point can interest rates go up before America defaults on its debt? Boy, I mean, that's where the screen just goes black, doesn't it?
I imagine so the reason I'm asking the question, right? So let's say inflation stays at 8%, and the Federal Reserve wants to put its rates up all the way to 8%. Can America afford all its debt at that point?
Yeah, I mean, certainly America will, I mean, when you think about what it'll have to do to support higher debt levels, and increases taxes, it finds other sources of revenue. But the notion that there is a number out there that America defaults on its debt, it'll just keep printing money. And that's I'm not saying that's the right solution, but ultimately that's the solution to higher interest rates and default risk, is you just keep printing greenbacks, and it creates massive inflation, rise in interest rates, and the necessity to tax the population further. And we could see worse than recession, but that's how you prevent default. You just keep printing currency.
And there seems to be no shortage of that over time. I think 40% of all dollars have been printed in the last like two years or 3 years or 4 years.
Right.
Is this not a big story? Is this not a big worry, or are you not concerned about this at all?
Oh, well, there's always concern about it. I mean, that's why we have this balance sheet problem in the U.S. That's why we have this deficit problem in the U.S. is that the attitude is you can just keep printing money. I mean, the U.S. Congress goes through this every year, where it has this concept of a budget ceiling that is really a joke, because the ceiling just gets raised every year. We just say, we'll print a little more, and this does become a problem for, I put this in the same bucket as sort of climate change, right? We're pushing these issues off to the next generation. And that is, that's the challenge. One of the challenges with a democratic capitalist system is that we live very much for today. There isn't enough sort of balance for the future, if we will. So as long as we continue to push off all of our problems to the future, and we do that because we don't want to take the medicine for the present. So I don't mean to end on a negative note, but we make it a problem for the future, whether it's our budget deficit or the Earth's problems as it relates to climate. So the short answer is, yeah, we can always just print more, raise more revenue, and print more money, and that continues to push it off down the road.
Well, yeah, the reason I asked the question is because it's what goes around the YouTube channels is they go, America's about to collapse, the entire system is about to collapse. They're going to default on their debt, etc. And so clients send you these things, and you keep saying to them, look, this is not a reality for us right now.
No, it isn't. I mean, this is a whole nother webinar discussion on the rise and fall of civilizations, right? Where we start talking about what brought down, I mean, you just made the trip to Rome, which used to be the center of, if not the center of the world, the center of the universe, right? What happened to Rome and its rise and fall, and the rise and fall of the Greek Empire and other great empires around the world? That's a history discussion that we could have, that happens over sort of the centuries, and those events do take centuries to occur. So that can be our next client webinar, sort of these philosophical, long-reaching discussions on what will happen to modern democracy and the rise and fall of civilizations.
Lovely.
Excellent. What a note to end on there, gentlemen. As always, an interesting discussion. Thank you to the over 100 participants that are still watching right the way to the end. So thank you all for taking time out of your schedule to come and listen. Thank you very much to Rob taking time out of his busy diary from
Thanks for having me.
Boston.
Appreciate it.
Very, very welcome. And Lawrence, thanks again for putting together such a fantastic event. I hope everybody enjoyed it. Ladies and gentlemen, have a great day. Bless.
Bye-bye.
Cheers.